The second category of financial products is the supply and demand of foreign currencies. Foreign currencies, or forex, are currencies that are used in other countries or regions. The euro is an example of a currency of a monetary union, where several countries have agreed to use the same currency. The buying and selling of forex is done on the foreign exchange market. Possible sources of forex transactions are payments and receipts as a result of international investing or borrowing and lending. They can also be the result of trading of goods and services. Let's do an example. Suppose that the US government borrows money to cover a budget deficit. A potential investor can be in a European pension fund. The pension fund will need to buy US dollars by selling its euros to be able to lend dollars to the US government. Let's do another example. Let's say a Dutch producer sells its products to an American company that will pay in US dollars. Since the Dutch exporter's expenses will be in euros, the exporter wants to sell the dollars at the occurring exchange rate, known as the spot rate, to receive euros to pay for its expenses. Now let's add another aspect of forex, market risk. Suppose that the Dutch exporter and US client from the previous example agree that delivery of goods and the payment of US dollars will occur 1 month from today. This creates a possible problem for the Dutch producer. If the dollar decreases in value during the coming month, the Dutch producer can buy less euros by selling the received dollars and suffers an exchange rate loss, or forex loss. At the same time, if the dollar increases in value, the producer has an exchange rate profit. So this means that the producer is exposed to exchange rate fluctuations of the euro against the dollar and may experience a loss. The historic euro-dollar exchange rate fluctuations illustrated in this graph are a good indication of the basis for currency market risk assessment. It shows the historic development of the value of 1 euro in US dollars since 1999. In October 2001, the euro had a value of approximately 82 US dollar cents. However, in July 2008, the euro value had increased to $1.60, almost double its value compared to 2001. Now this proves that the euro-dollar exchange rates changes can be fast and unpredictable. Future forex receipts and payments create an exposure to changing exchange rates, with potential substantial negative results. Luckily, there is a possibility to transfer this foreign exchange rate risk by selling it to a risk buyer. These risk transfers can be easily made by using the third traded product category on the financial markets, to buy and sell risk by derivatives.